Hey everyone, George here. Today we're going to talk about one of the most confusing things to contractors when they start making real money and want to become official. Should you form an LLC? Should you stay an LLC? Should you switch to an S Corp, a C Corp? Because you hear people say all kinds of stuff like S Corps help save in taxes and C Corps are better for rich people. And my buddy's accountant said this. And half the time they don't even fully understand the full ramifications of each one. So today I'm breaking down what an S Corp actually is, how it's taxed differently than a C Corp, why S Corps can be great for contractors, disadvantages no one really tells you, and what to watch out for if you convert. So without further ado, let's get started. Let's start with what an S Corp really is. An S Corporation isn't a business type like an LLC. An S Corp is actually a tax election you make with the IRS. And that means you usually start it either as an LLC or a corporation. And then you choose to be taxed as an S Corporation. A big difference between C Corps and S Corps is how the income is reported and taxed. The key point for contractors is that an S Corp is a pass-through entity, meaning the income flows through to the owners and they pay tax on it at their individual tax rate. A C Corporation is different. It is its own paying entity, and it pays income tax separately than its owner or owners. Why do contractors love S Corps? What's the number one reason they use it the most? Number one, an S Corp avoids double taxation. With a C Corp, you get hit with double taxation. The owner pays tax once at the C Corp level and a second time at the personal level once those profits are distributed. An S Corp avoids this because the profit passes through to you. Number two, losses can help personally. This matters more than a lot of people realize in construction, especially in the early years. For example, you buy a truck, you load up on tools, you hire people, you have a rough start to the year and the business shows a loss. With an S Corp and other pass-through entities, your losses can pass through to you personally, which can help offset other income on your personal return, though that comes with an asterisk. There are some restrictions. That can be huge in startup phases or in heavy equipment purchase years. But let me give you a simple example, and this happens all the time. Say you have one spouse working and that spouse makes $100,000 in W-2 wages. And the contractor business, it's a new business, a startup, it loses $25,000 in the same year. If it's a pass-through setup like an S Corp, that $25,000 loss from the contractor business can offset the $100,000 of W-2 wages from the spouse in that tax year. So now instead of being taxed on that $100,000, you're actually taxed on $75,000. So that's a good reduction, but here's the kicker. If that was a C Corporation, that $25,000 loss would be stuck in the corporation and you wouldn't be able to use it to offset any of your personal income. That's one reason contractors typically like pass-through structures, especially at that point in the business life cycle. A lot of contractors might think that an S Corp means no taxes or I don't have too many return filings. So that's not entirely accurate. Even though an S Corp itself doesn't pay any federal income tax, it still files a corporate return every year, the 1120S. And that return reports the business income and expenses, the profits and losses, and then that taxable income or loss flows through to your personal return. Another big S Corp advantage for contractors is a reduction in the self-employment taxes. Now, this is one of the biggest reasons a contractor might get excited about an S Corp. If you're a sole proprietor or an LLC taxed as a sole prop or a partnership, a lot of the income is hit with self-employment tax. But S Corp shareholder employees can structure it differently. You pay yourself a reasonable compensation, a W-2 salary, and then take the remaining profit as distributions. And S Corp distributions are not subject to self-employment tax, Social Security, and Medicare the same way wages would be. But this doesn't mean you don't pay tax. It means that you reduce the self-employment portion based on what you call a reasonable compensation, which you're required to do, and taking the rest as a distribution versus the whole net income at an LLC, a sole proprietorship, would be taxed with that self-employment tax. So it's definitely a significant reduction in the self-employment tax. Next, I want to talk about the IRS audit myth. You might hear people say S Corps don't get audited or it's super rare. And that's not entirely true. The rate at which they get audited is significantly less than the audit rate of a sole proprietorship. Because now as an S Corp, you're in the corporation bucket, so you're one of the smallest fish in that sea. Versus if you're a sole proprietorship and you're making seven-figure, million, 2 million top line and especially bottom line, then now you're one of the biggest fish in that sea. So it's an audit rate of 5% versus less than 1%. So it is significantly lower audit risk, but you wouldn't choose an entity type just based on audit risk alone. It is already a smarter structure and more tax efficient. So now that begs the question, should you choose S Corp status? Most people incorporate not just for a more efficient tax structure, but also for more liability protection. Because contractors can often deal with customer lawsuits, job site disputes, employee issues, subcontractor problems, and injuries and claims. So if you have the right structure, it could really help separate your personal assets from the business. And corporate shareholders are typically not liable for business debts. That being said, you still need to do things right, meaning insurance, clean contracts, separate bank accounts, clean bookkeeping, and payroll compliance. An entity alone wouldn't save you if your bookkeeping and accounting is just sloppy. What do you have to do to qualify to successfully elect S status? So number one, the corporation has to have no more than 100 shareholders. Shareholders must generally be US individuals or residents. Only one class of stock and all shareholders must consent. And the election is made using the Form 2553. And to be effective for S Corp status, the 2553 must generally be filed within the first 2 months and 15 days of the tax year. Now, there is late election relief, and with that, you can go as far back as 3 years and 75 days. But don't wait too long, or if you miss this window, you could be stuck for that year and just have more taxes owed. What are some things to watch out for with an S Corp? Number one, taxes on paper profits. If your business is showing a high net income, high taxable income, again, being a pass-through entity, this would flow through to your personal side and accrue taxes there. Which leads me to my second point, which is quarterly estimated tax payments. Even though the entity itself doesn't owe any, you still need to do a quarterly calculation and pay in your quarterly estimated tax payments at the personal level based on income accrued at the S Corp. So this is something you can work with your accountant, your CPA on. If you don't have one, we're happy to speak. Our calendar link is down in the show notes. And another way to go about this is to actually pay your reasonable comp to yourself and withhold taxes monthly, semi-monthly, or however you want to pay yourself. One more downside is that there's limited fringe benefits. For example, for health insurance, if you're a 2% or more shareholder owner, it needs to be added back to income, and you need to actually include that on your W-2 potentially to be deductible through your personal tax return. Another thing to watch out for is if you've already been a C corporation for a number of years and you want to elect and become an S corporation, there are a few possible triggers that could take place. If you had passive income, if you use a LIFO inventory, last in, first out, if you had unrealized gains or sold appreciated assets after converting, then converting isn't always a free move and it could potentially trigger some tax. If there's any one of these four general things, consult with a professional before converting. Finally, we get into the S Corp reporting deadlines. When are the returns and everything? An S Corp typically files by March 15. That's the typical deadline. This year in 2026, March 15 falls on a Sunday, so it's March 16, 2026. And you can always file for an extension of Form 7004 and extend it to September 15. So again, S Corps can be a great move once your business is profitable. They help avoid double taxation. They can allow better tax planning at that point in the business life cycle as compared to a C Corp. But they still require payroll, tax filings, and tax planning. I hope you found this helpful. If you have any questions or any of this applies to you, our calendar link is down in the show notes, and see you in the next one.